Here are 4 dividend growth stocks that have grown their dividends consistently over the past few years and are actually stocks that I don't own but would like to own down the line, and even replace some of the current stocks that I own that don't grow their dividends as fast. So let's start things off with Microsoft, the first company on this list. And yes, I can't believe I don't own this great company. It's one of the biggest companies in the world and in the tech space. Some of the things that I like about Microsoft is Microsoft Azure, which is the #2 player in cloud computing with ridiculous growth. And as you can see here in their year-over-year numbers, just absolutely ridiculous growth by Microsoft Azure, and as well as in their intelligence cloud segment part of their business, also showing very strong growth over the past few quarters. Now also, I like their subscription-based business model. Now this comes mostly from their Microsoft Office 365 suite, which has been transitioning to a subscription-based revenue stream, and as well as their gaming. Microsoft is a player in the gaming space, which also doubles down as a subscription part of their business with Xbox Game Pass. And I think that's a very nice business that Microsoft has, and it's really good for investors that don't necessarily want to be too into gaming, but have some gaming exposure in their portfolio. Now, talking dividends, Microsoft has increased their dividends by 10% over the past 5 years, and they increased their dividend by 10% in 2020. Now, as far as 2021, they are projected to increase their dividend by about 10%. They're still pending their dividend increase in the fourth quarter of 2021. So we'll see how that goes, but it's going to be around 7 to 10% for the year, which is absolutely great. Now, as far as their dividend yield, and see if we can find some value, their 4-year dividend yield average is about 1.38%. And currently right now on a forward basis, we are looking at around a 0.8% yield, maybe a little bit higher if you factor in the increase of their dividend that they hopefully do in the fourth quarter. But needless to say, there is a little bit of a premium in Microsoft, but then again, when isn't there a premium with Microsoft? All right, so let's take a look at earnings. Now, before we talk about earnings, just take a look at this. The past 4 quarters have been beats across the board, and take a look at their year-over-year growth for the next 4 quarters. Absolutely love to see this in companies, and Microsoft, one of the best to do it when it comes to beating on earnings per share and growing their earnings each and every quarter. Now, for the next 4 quarters, they are projected to do about $8.75. That puts them at a forward PE of about 32, which is a bit of a premium considering that their 5-year average is about 29. But again, for a company like Microsoft, you're gonna have to pay to play to be an investor. Now, just for fun, if you do get this company under a 30 PE, let alone at a 27, 28, we would be looking at about 236 to 235 at a discounted price. Now, the stock is currently trading at 285, so would it drop to those price levels? Probably not, honestly, but I still think that even at these current prices, it's pretty good buy if you're willing to dollar cost average each and every month. I mean, they are a good company to do this with. They have an incredible moat. They continue to see growth in Microsoft Azure, in their subscriptions, in gaming, and as well as in Teams. So it's definitely a company that I really like, and there's not really much negative things to say, but if there is one thing I would say is that the cloud computing space, or that market, is dominated by Amazon's AWS and as well as Google, which I believe comes in third. Even though I think Microsoft is a very strong player in this segment, just keep in mind that the competitors are no slouches in Amazon and in Google. Now, as far as Microsoft in my portfolio, of course, I don't own the stock, but I do want to replace Intel Corporation that I do currently own with Microsoft. I think Microsoft is just a better overall company, and as well as their dividend growth is a lot stronger than Intel. Not to say Intel's a bad stock, but I think Microsoft, if I'm looking to replace a company in my portfolio right now, I think I would like to switch Intel for Microsoft. Moving on, we got American Water Works. Now, American Water Works is the biggest player in water utility companies. They're the most diverse water utility company as they're regulated in 16 states, and they have consistent earnings and dividend increase over the past years. as we can see with their EPS as well as their dividend payout. Now, talking about that dividend growth rate, we have seen American Waterworks grow their dividends by 10% over the past few years. They just grew their dividends in 2020 by almost 10%. And if we look at the forward dividend for 2021, it is just under 10%, but we got to round up to get that 10% increase. But either way, an 8 to a 9, 10% dividend increase is extremely good and always welcomed in my portfolio. Now, when it comes to their 4-year dividend yield average, they've averaged about a 1.7 dividend yield over that time frame. And currently right now, their forward yield is about 1.42. So there is, again, another premium on top of American Waterworks. And if we move on to earnings, we actually see the same thing with their expected EPS for the next 4 quarters at around $4.22. That puts them at a ridiculous forward PE of 40. Considering the fact that their 5-year average is 33, you're definitely paying a premium at these current prices. But then again, American Waterworks kind of does deserve this premium. They're by far in a way the biggest water utility company. And if any company deserves this premium, it would be American Waterworks when we're talking about water utilities. Now, honestly, just for fun, I don't think the stock will ever drop to these prices. If we're looking at a forward PE of under 33, dare I say in the 30s, we're actually looking at a 126 to 135 price point for a not so big of a discount, but a discount nonetheless. But yeah, that doesn't really matter when the stock is trading at $170 a share. Now, again, like I said, they're the largest water utility company. They have a strong regulated business, but there are some risks. I mean, this kind of applies to all utility companies, but specifically with American Waterworks, it is a capital intensive industry, and that definitely affects the company if they're not able to make those capital investments and able to take out the loans to be able to expand their operations, as well as there's uncontrollable factors like weather and water contamination, which could obviously hurt American Waterworks if those things were to happen. But nonetheless, it is a very strong business, the best water utility company, I think, in the stock market right now. And for this company, I honestly would like to own it. I wish it could be cheaper, but I would like to replace it with Con Ed in my portfolio, Consolidated Edison. Now, that's a electric utility company, a very good company actually. They have a really high yield, but they don't really grow their dividends by double digits like American Waterworks. And that would be an interesting replacement in my portfolio, switching out an electric utility and adding in a water utility company. So moving on, we got Costco Wholesale. Now, Costco is one of the largest warehouse retailers. I think they're 3rd largest in the world. They continue to expand their domestic and international warehouses, which is absolutely great. And they have consistent revenues and earnings, about as consistent as it gets. Just take a look at their earnings over the past 5 years, up and to the right. Now, when it comes to their dividend growth, they've been growing their dividends over the past few years at about 10-12% clips. Now, if you look at the growth rate in 2020, you see this ridiculous number, and that's because they added a special dividend in that year. But typically speaking, if you factor out these special dividends that they pay, they typically grow their dividend between 10 and 12%. And for 2021, it's actually looking like it's going to be a 12% increase, unless they do a special dividend, which I don't think they will. But still, a company growing their dividends at 12% is absolutely awesome. And then on top of that, you might get a special dividend. Man, you gotta sign me up for this company. But yeah, taking a look at earnings, they're a strong earnings company, like I mentioned. For the next 4 quarters, they are projected to do about $11.18. That puts them at a forward PE of 38. And with an average 5-year PE of about 31, again, you're seeing a pattern here with the premium on these companies. Just because they're such dominant players in their respective industries, you're going to have to pay up to own these companies. Now, if you can get this stock under a 30 forward PE, you'd be looking at about 325 to 335 as far as the price point. But right now it's trading at 429. I don't think you're gonna be able to get this company at a 30 forward PE anytime soon. But if you're willing to dollar cost average, I would be a fan of doing that for Costco. I mean, they continue to expand their warehouse operations as well as their e-commerce. It's not too big of a business yet in Costco, but that's something that they're definitely continuing to work on. And it could be some great upside for Costco in that regards. Now, as far as downsides, I would like to bring up the competition from other online retailers and other warehouse retailers, specifically with BJ's Wholesale Club and Sam's Club. Now, funny enough, Sam's Club is a warehouse from Walmart, a company that I own, but I wouldn't change Walmart for Costco. I would just add Costco to my portfolio. But yeah, definitely Costco, great stock, great dividend growth rate, and I would like to add it in my portfolio. And finally, last up here, we got Abbott Laboratories. Now, Abbott Labs is a great company with great brands and products, as well as they are extremely diversified. I mean, just take a look at all of the products that they offer. They have cardiovascular care, diagnostics, diabetes care, nutrition, and they have great brands that I actually know myself, like Pedialyte and Ensure. They're actually really good brands. As you can see, they're number one in a lot of categories. And that's something that you like to see when it comes to these companies, dominant players in their respective industry. And when it comes to Abbott Labs, you get a more defensive healthcare play, in my opinion, as they don't really rely too much on drugs as a main part of their business. They used to, and I think 2013 when they spun off AbbVie, but as of right now, Abbott is more focused on medical devices and diagnostics, which is a lot more consistent than drugs and having drugs approved and then having those patents expire. So this is actually a really nice company to have in the healthcare space, along with the other pharmaceutical companies. And on top of that, they still have upside potential with COVID-19 test kits, but it wouldn't be the main investing point, at least in my opinion. Now, when it comes to dividends, Abbott has been increasing their dividends for the past 5 years at about 8%. And in 2020, they did increase it by 12.5%. And now for 2021, we're looking at a 25% increase, absolutely insane. I wouldn't bank on them increasing their dividends at 20+% like they just did in 2021, but I could see them continue to increase their dividends by about 7, 8, 9, 10% range, which would absolutely be great for dividend investors. Now, when it comes to their 4-year dividend yield average, they typically trade at around 1.6 for their dividend yield. Right now, they're at about 1.4. So there is, again, a little bit of a premium, but actually one of the better values of the list that we just went over. Now, when it comes to earnings, we do have the projected 4 quarters for Abbott to come in at about $4.20. That puts them at about a forward PE of 29, just under 29. And with their 5-year average PE of about 30, this is actually a stock that's trading near fair value at about 118 to 121. And the stock is trading at 120. So I think Abbott is a great alternative to the typical drug companies that you see in the healthcare space. They don't really need to worry about the next big drug that's going to drive their sales. They're way more defensive with their medical devices and diagnostics. And they're also a dividend grower, as you saw by their dividend growth rate. And they're actually a dividend aristocrats with, I think, about 48 or 49 years of dividend growth. They're about to be a dividend king. The only downside I do see for Abbott is that you're paying a pretty high premium for growth that's potentially going to slow down in 2022. Depending on how the COVID situation ends or plays out, that could be a risk for Abbott. But regardless of that, I would actually like to own this company in my portfolio, and I'd probably switch out CVS. Now, CVS is actually a company that I've owned for quite some time now, a few years actually, but they just don't grow their dividends, and that's for obvious reasons with their Aetna acquisition and their debt levels. But still, they don't grow their dividends, and my portfolio is basically focused on growing your dividends as the stocks in my portfolio. But yeah, those were the 4 companies that have grown their dividends at a really good growth rate and could be a great addition to any dividend investor portfolio. Hopefully the video was helpful, and thank you so much for watching.